Welcome to episode 4 of Stock, Paper, Scissors. I'm Ben, and as always, I'm joined by the voice of reason herself, Alex. And today, we're looking at the secret engine room of the entire global economy. Most traders are staring at the flashing green and red lights of the S&P 500, but the legends, they're watching the bond market. If you want to know when the stock market is about to walk off a cliff, you don't look at the stocks, you look at the yields. It's like the stock market is the kite, but the bond market is the wind, and the wind just changed direction.
The wind just changed. You're already getting poetic on me, Ben. But yeah, you're right. We ended the last episode talking about slopes. Moving average slopes, and I promised we'd go deeper. But I didn't mean a ski slope, I meant the yield curve, which honestly sounds like the most boring thing you could talk about at a party. Hey, want to see my curve? No one says yes to that.
Hey, I said yes to that. I remember back in 2018, I was at this dinner and I literally pulled up the 2-year versus 10-year Treasury spread on my phone mid-appetizer. My date thought I was texting an ex. I was like, no, look, it's flattening. There was no second date, Alex. But the point is, bonds are the smart money. It's where the big institutional, I have $10 billion to protect money lives. And when those people get scared, they move the needle in ways a retail stock trader can't even imagine.
Right. And for anyone listening who's thinking, wait, I thought this was a stock game, you have to realize that stocks don't live in a vacuum. Everything is connected. When bond yields start creeping up, specifically that 10-year Treasury yield, it acts like gravity. If yields go up, the gravity on stock prices gets heavier. It makes it harder for those high-flying tech companies to keep floating. Exactly.
It's the golden rule of the markets. The 10-year Treasury yield is the gravity that pulls down every stock's valuation. Think about it. If I can get a guaranteed 5% return from the government just by sitting on my hands, why on earth would I risk my money in a volatile AI startup that might go to zero? I wouldn't. Or at least I'd demand a much lower price for that stock to make the risk worth it. When yields rise, people sell stocks to go buy the safety of bonds. It's a massive tug of war.
Wait, then slow down a second. You're getting into the risk on, risk off thing. Let's make this real. Tell me about a time this actually happened. Because right now it just sounds like math. And I know you have a story somewhere in that head of yours.
Oh, I've got a story. Do you remember 2007? Not the music. I know you loved the emo phase, but the market. In 2006, something weird happened. The 2-year Treasury yield actually became higher than the 10-year yield. That's the inverted yield curve. It's like, imagine going to the bank and they tell you a 2-year CD pays more than a 10-year CD. It makes no sense, right? It's upside down.
It's basically the market saying, we think the near future is way scarier than the distant future. It's a vote of no confidence in the economy.
Exactly. So in early 2007, the curve was inverted. Stock traders were still partying, though. The S&P was hitting new highs. Everyone was saying, this time it's different. Housing never goes down. But the bond market was screaming. It was like a fire alarm going off in a crowded nightclub, but the music was so loud that nobody heard it. Then, eventually, the music stopped. The bond market was right. It's actually a historical fact. 100% of the last 10 U.S. recessions were preceded by that 2-year, 10-year inversion. Every single one.
Okay, that's a terrifying stat. But hold on. If it's so accurate, why doesn't everyone just sell the second it happens? There's a catch, isn't there? You're giving me that I know something you don't look.
You know me too well. The catch is the timing. It's like, it's like seeing a dark cloud on the horizon. You know it's going to rain, but you don't know if it's in 10 minutes or 2 hours. Usually the crash doesn't happen while the curve is inverted. It happens shortly after the curve uninverts, when the yields start rushing back to normal. It's the lag that kills you. Traders get impatient, they go back into stocks, and then the floor drops out.
So it's a leading indicator, but it's a slow one.
It's like a warning light on your dashboard that tells you your engine is going to explode eventually. Drive safe, but maybe don't go on a cross-country road trip right now. Hold on, let me pull up this chart on my phone. I want to look at the 1929 one you mentioned last week.
Oh, 1929 is the godfather of bond warnings. People forget this, but before the Great Depression hit, call money rates, which were basically the bond market proxy for margin loans, hit 20%. Imagine trying to grow a business when the interest rate on your debt is 20%. It's impossible. The bond market choked the life out of the stock market. It was a massive red flag that everyone ignored because they were too busy buying RCA stock on 10-to-1 leverage.
It's funny how it always comes back to leverage and greed, isn't it? But for us today, especially for people playing Hedged, how do we use this? Are we just looking for the inversion, or are we looking at the absolute levels?
Both. But the big takeaway is the correlation. Usually stocks and bonds move in opposite directions. When stocks go down, bonds go up because people want safety. That's the traditional way. But in a crash predictive scenario, you often see yields rising first. If yields are spiking and stocks are also trying to rise, that's a divergence. That's the market lying to you.
Wait, let's go down the rabbit hole for a second. You once told me you tried to explain the yield curve to your nephew using Legos. Please tell me that story actually happened.
Oh God, it was a disaster. I tried to show him that a long Lego bridge, the 10-year bond, needs more support than a short one, the 2-year. But then I started talking about inflation expectations, and he just looked at me and asked if we could play Minecraft. He was 7, Alex. I think I traumatized him against finance for life. He probably thinks bonds are just plastic blocks that make your uncle act weird.
At least he's honest. Most adults just nod their heads and pretend they understand when you start talking about basis points. Okay, back to the serious stuff. If someone is looking at their portfolio right now and they see the 10-year Treasury yield is jumping up, what's the immediate vibe check they should do?
The vibe check is, who am I holding? If you're holding high debt companies or aggressive growth stocks that aren't making money yet, rising yields are your worst enemy. They are the kryptonite. But if you're holding, say, big banks, they might actually like it because they can charge more for loans. Intermarket analysis is about realizing that a move in one room, the bond room, changes the temperature in every other room of the house.
I like that. The temperature of the house. So if the bond room is on fire, don't be surprised if the kitchen starts getting smoky. You mentioned a golden rule earlier. Can we solidify that? For the folks at home, what's the one sentence takeaway for their next trade?
Here it is. The 10-year Treasury yield is the discount rate for the world. When it rises, the present value of future profits falls. Basically, higher yields equal lower stock multiples. If yields are skyrocketing, stop expecting your favorite tech stock to trade at 100 times earnings. It's just not going to happen.
That feels like a punch in the gut for a lot of people who only started trading in the last few years when yields were basically zero. It was like living in a world without gravity. You could just jump and never come down.
Exactly. And now gravity is back. And it's a bit of a shock to the system. But that's the beauty of intermarket analysis. It gives you a map. While everyone else is wondering why their stocks are dropping for no reason, you're looking at the bond market and saying, oh, I see exactly what's happening. The wind changed.
I think I'm actually starting to like the bond market, Ben. It's like the grumpy old man who's always right about the weather. You don't want to hang out with him, but you definitely check his porch before you go for a hike.
He's the ultimate I told you so of the financial world. And honestly, if you can learn to respect the yields, you'll survive the crashes that wipe out everyone else. It's not about being afraid, it's about being prepared. Like, if you're driving right now, don't try to look up a yield curve chart. But when you get home, pull up the 10-2 spread and just look at where it was in 2000, 2008, and 2020. It'll blow your mind.
It really is a pattern. It's not a coincidence if it happens every single time. All right, I think my brain is sufficiently full of debt instruments and economic omens. Shall we wrap this one up?
Let's do it. Key takeaway for today, bonds are the boss. When yields rise, stocks feel the weight. And when the curve inverts, the clock is ticking. It doesn't mean sell everything today, but it means put your seatbelt on. The flight is about to get bumpy.
Seatbelts on. Bonds are the boss. Got it. And hey, maybe next time we can talk about something a little less impending doom-ish? Just a thought?
No promises, Alex. The market is a wild place, but we'll be here to navigate it together. This has been episode 4 of Stock, Paper, Scissors. Just a reminder, we are financial educators, not advisors. Everything we talk about is for education and the hedged game. Always do your own research before putting real money on the line.
Well said. We'll see you all in the next one. Keep your eyes on those charts and maybe one eye on the yields too.
See you next time on Stock, Paper, Scissors.